Welcome back to the deep dive. Figuring out which dividend stocks are solid and which ones might just be noise, it's a real challenge for income investors. We've got quite the pile here today, recent quarterly reports, Kenanga analyst notes for 10 big Malaysian names, and your custom intrinsic value calculations using that Gordon growth model. So our mission, not just listing yield, we're going deep, like a forensic analysis on these 10 stocks. We need to figure out, who fits where, income growth, balanced investors, and crucially, find those hidden risks or maybe those aha moments in the fine print.
Exactly. It's about getting past the headlines today. We need to see where the value really is, or maybe isn't. We'll be looking hard at how the current market price stacks up against Kenanga's target price and what the intrinsic value suggests. If analysts see a lot of upside, why? And if a stock's already trading high, what's the market really betting on?
Okay, let's dive in. Starting with the big one, banking. 6 major players here. And for banks, the key things are always net interest margin in IME, that's lending profitability, return on equity, ROE, for efficiency. And crucially, asset quality, the gross impaired loans, or GIL ratio, lower is definitely better there, keeps bad debts from eating profits. Let's kick off with Malayan banking Berhad, Maybank. Looks like a story of resilience. Their group CFS profit before tax was up 16.1% year-on-year in Q3 2024, mostly lower impairments helping out there, and they're hitting their 11% ROE target for the year.
Right, and that really matters because they followed through with a pretty substantial dividend 32 sen paid back in March 2025. That kind of payout, well, it's management signaling strong confidence in their cash flow going forward. Kenanga agrees they rate it outperform, TP at ARM 11.30. The current price is, 9.84. So yeah, that's not just income potential, it's analysts seeing room for the stock price itself to grow.
Okay, the regional anchor looking solid. But then you have Leong Bank Berhad. This seems like confidence dialed up even further. Their FY25 net profit, RM 4.68 billion, actually beat the forecasts. Loans grew 8%, and IM held steady at 1.79%. But the real kicker is the dividend payout ratio.
Yes, that's the fascinating part here. They hit a 47% payout ratio for the full year. Compare that to their historical average, which is around 35%. That's a huge jump. It's a massive signal, really, a very quantifiable vote of confidence from management. They're basically saying, we have enough capital, things look good, let's return more to shareholders.
Kenanga has them at outperform too. TPRM 24.50 against the current 20.19. A pretty decent upside implied there.
Hold on, though. A jump from 35% to 47% payout. I mean, that's great for investors now, but is there any risk they're stretching a bit, maybe sacrificing future investment or capital buffers? Well, that's always the question you have to ask, isn't it? If their fundamentals were weakening, like if NIM was dropping or loan quality was suffering, then yes, absolutely, it would be a red flag. But because their NIM is stable and loan growth is still strong at 8%, the market tends to read this positively. Like it's a sustainable distribution of genuinely excess capital, not a desperate move.
Makes sense. Okay, moving to safety. Public Bank Berhad. They seem to be the leader when it comes to keeping that GIL ratio low. Really managing bad debts well. Forecasted dividend per share is RM 0.23, giving about a 5.2% yield.
Yeah, for investors who really prioritize stability, Public Bank is like the fortress. That top-tier asset quality gives a lot of assurance. And Kenanga rates them outperform at RM 5.25, plus a little ESG premium they add, the current price, just RM 4.27. So that's a pretty significant valuation gap. According to the analysts, you're essentially getting the safest bank at a noticeable discount.
Okay, let's quickly cover the other 3 banks. CIMB Group Holdings Berhad. Interesting profile here. The dividend growth has been, well, quite spectacular. Went from 5 sen back in 2020 up to 40 sen in 2024. That gives a yield of about 6.58% right now. High.
It is high, but, you have to look under the hood. It's like a two-speed situation. Dividend growth is strong, yes, but their consumer banking PBT actually declined in the third quarter, year on year. Why? Higher provisions for potential loan losses. So that's the tension. You're betting the growth continues to outweigh those provisioning needs. Kenanga still sees upside, though, TPRM 7.90 versus the current price of RM 7.26.
Right. Then there's RHB Bank Berhad. They've got solid loan growth up 5.9% in the first half of FY25. Interim dividend is stable at 15 sen. The weaker spot seems to be their non-fund-based income, things like fees, which dropped about 10.8%.
Yeah, something to watch. But Kenanga still rates them outperform, TP at RM 7.80 against a current price of RM 6.56. That's quite a discount the market is giving it right now.
And finally, AMMB Holdings Berhad. This one feels like a recovery story in progress. We don't have a current Kenanga TP handy, but the operational signals are strong.
Definitely. The GIL ratio improved down to 1.54%, and their net impairment charge fell dramatically, almost 60% year over year. Plus, their Islamic banking segment grew profits nearly 40%. So the data suggests they're actively cleaning up the balance sheet. Could be poised for a re-rating if this keeps up.
Okay, so that covers the banks. A lot of focus on NM, ROE, GIL. But things change when we look outside finance. Let's pivot to industrials and services. MISC, Petronas, Dagangan, Maxis, and CIMB Darby. The risks here might be hiding in different places. Starting with MISC Berhad, the shipping giant. First glance, maybe a bit shaky. Total equity down 4.3% because of the ringgit versus US dollar. And they booked some really big impairment losses on ships RM 656.7 million.
Whoa, hang on. Over 650 million in impairments. That sounds like it should crush their cash flow, right? But here's the aha moment, particularly for income investors. Despite those huge write-downs, despite the currency swings, their dividend per share has been incredibly stable. It's hovered between 33 and 36 cents every year from 2020 to 2024.
Really? It didn't drop at all.
Not really, and that tells you something vital. Their core cash generation, probably from those long-term stable contracts like for LNG transport and offshore assets, it seems completely insulated from these accounting impairments. Kenanga sees stable yields around 4.7% going forward. They rate it outperform TP RM 8.17 versus the current RM 7.45. Shows resilience.
That is a key insight. Okay, shifting to consumer. Petronas, Dagangan, Berhad. Very cash generative. Retail volumes growing, and they're pushing hard on that convenience side like Cafe Mesra.
Yes, strong operations, but the immediate flag here is valuation. Kenanga's discounted cash flow model points to a target price of RM 21.20. But look at the market. It's trading at RM 22.30 right now.
So it's already above the target price.
Exactly. It suggests the market might be priced to perfection, as they say. Investors seem to be paying a premium already for that successful non-fuel growth. Caution needed if you're looking for near-term capital gains.
Got it. Then Maxis Berhad, the telco. Tough competition in that sector. Their guidance is pretty muted, low single-digit growth for revenue and EBITDA in FY25. Seems their focus is more on efficiency and paying down debt. Net debt to EBITDA came down nicely to 1.99x.
Right. We don't have a Kenanga TP comparison here, but the story seems to be about defense, strengthening the balance sheet, focusing on operational tweaks, maybe growing the enterprise side, rather than pushing for big dividend hikes right now.
And the last one in this group, Sime Darby Berhad, industrials and automotive. They did raise their margin assumption for the auto side to 2.6%, but there's a big red flag on the dividend front.
A very clear one. They reported no dividend income from BMW Malaysia in the fourth quarter of FY25. That was RM 140 million the year before, apparently pushed back due to competition impacting BMW's results. That's a direct hit to CIMB Darby's cash inflow for that period.
And even though Kenanga nudged their TP up a bit to RM 1.90, the stock is trading at RM 2 by 10.
Yeah, so not only does it look stretched on valuation relative to the analyst target, but you have this very concrete recent disruption to a significant chunk of cash flow. That warrants serious caution.
Okay, good time for a quick pause. If you're finding this deep dive useful, maybe hit that subscribe button so you don't miss what's coming next. We really appreciate the support.
All right, so let's try and connect these dots now. Looking across all 10, the valuation gap is really telling, isn't it? You've got a clear group, AmBank, Public Bank, RHB, Maybank, CIMB, and MISC, where the current market price is quite a bit lower than Kenanga's target price. That's where analysts are pointing towards potential undervaluation, suggesting room for the price to catch up.
And on the flip side, Petronas Dagangan and CIMB Darby are trading above their TPs. Signals potential overvaluation, or at least that the good news is fully priced in. It really highlights that investor choice, doesn't it? Pay a premium for perceived growth or quality, like PETDAG's convenience stores, or look for value in potentially overlooked names.
Absolutely. So let's try to categorize them based on what kind of investor might find them attractive. First, the income investor. Priority number one is stable, reliable dividends. You want resilience, you want proof of commitment. For them, I'd highlight Maybank, just solid, reliable. MISC Berhad, because of that amazing dividend stability, even with those impairments, shows the strength of their core contracts. And definitely Leong Bank, that big payout increase is a major confidence statement.
Okay, what about growth investors? They're looking more for the stock price to go up, focusing on earnings potential, and buying undervalued stocks relative to targets.
Right. For them, CIMB stands out. Yes, there's that provisioning risk we discussed, but the dividend growth trajectory has been phenomenal, and there's still that gap to the target price. And RHB Bank looks interesting too. Decent loan growth combined with that significant discount to its TP of RM 7.80, potential for a re-rating there.
And finally, the balanced investor. Someone looking for a mixed, decent yield, but also quality growth and maybe less risk.
Here, Public Bank is a prime candidate. You get that best-in-class asset quality, the low GIL ratio, plus a solid yield forecast and that big valuation gap. It's defensive with upside. And AMB Holdings could fit here too as a recovery play. The improvements in impairments and the growth in Islamic banking are really positive signs for future potential, balancing risk and reward.
Okay, decision time. Let's try and rank these based on everything we've discussed: financials, analyst views, dividend certainty, valuation. Seems pretty clear that Petronas, Dagangan, and CIMB Darby, trading above TPs, and with CIMB Darby's dividend issue, are the ones needing the most caution. Let's call them avoid or maybe cautious hold for now.
Agreed. The 6 banks and MISC generally fall into the high conviction buy or hold categories, depending on individual risk, appetite, and focus.
So let's narrow it down. The top 3 overall picks. Where's the best combination of safety, yield confirmation, and valuation appeal?
Okay, number 1 for me has to be Leong Bank Berhad. Why? It's that confirmed dividend sustainability shown by the jump to a 47% payout. That, combined with stable core metrics, is a powerful signal for management. One-liner. Best for income and confirmed management confidence.
Good choice. For number 2, I'm going with Public Bank Berhad. Why? It's simply that unmatched asset quality. The leading GIL ratio is a huge safety net, and you get that combined with a really significant valuation gap. Discounted safety, one-liner. Best for defensive stability and valuation discount.
Solid pick. And rounding out the top 3, I'd put Malayan banking, Maybank. Why? It's the bedrock. Consistent financial performance, strong capital, regional presence. It's the core holding that reliably delivers on its targets and rewards shareholders consistently. One-liner. Best for institutional resilience and core income generation.
Great summary. I think the big takeaway here is that dividend investing isn't just about chasing the highest yield number you see. You really have to dig into the reports. Look for genuine commitment to cash flow, like HLB's payout hike, or understand the underlying resilience, like MISC's contracts, versus maybe paying too much for growth, like the current situation with Petronas Dagangan.
And that leads to a final thought for you, the listener, to consider. Think about that contrast. Petronas Dagangan trading above its target price, arguably reflecting high expectations for its convenience growth. Then you have Public Bank, with top-tier safety metrics, trading at a deep discount to its target price. How much premium are you willing to pay for potential future growth versus the discount available for proven, current quality and safety, which aligns better with how you see risk and reward?
A perfect question to mull over. Thanks everyone for tuning into this deep dive. If you found it valuable, please do hit that subscribe button. And definitely drop us a comment. Let us know if there's another topic or set of source materials you'd like us to tackle next time.